Thank you very much. And I want to thank the SKOCH Foundation for inviting me to this. Um, Before I specifically answer that question, I just want to make a couple of points. I think it's important to understand that we actually have a lot going for us. From an economic perspective, macroeconomic stability, political stability are two important ingredients to attract any kind of investments. And I think from an investor standpoint, whether domestic or global, those are two things that most investors feel relatively comfortable. So that's important. The second point I would make is that from a growth perspective, and since the topic is about growth and employment, a lot of it has to do with domestic factors. As an economy, we are less reliant on exports relative to China or certain other economies, and therefore there are enough prospects for growth domestically that we need to capitalize on. So far, there have been only two engines that have been firing really for the last few years, and that's been consumption and government spending. I think private sector capex and rural consumption are two areas, and rural investments are two areas that need to really ramp up in order to make sure that the economy can get from the 6% to 8%. It won't get there purely on consumption and government spending. And as you rightly said, there's a lot of money available, whether it's domestic or international, that's looking for growth opportunities. So it's really up to us how we capitalize on this dynamic of enough liquidity and capital that's searching for yield and growth, where our own prospects are really up to us, and it's really we can control to some extent our own destiny, because there's enough growth available domestically if we focus on the right kind of policies and the right kind of sectors. So the third point is, what do we do to ramp up growth and employment? And I think, as I said, just consumption-related sectors will not work unless we get infrastructure, real estate, and construction going. It's going to be difficult for us to try and get private sector capex and employment ramped up. And that's because these sectors actually impact a lot of associated sectors that are capital intensive, whether it's steel, cement, mining, etc. And the kind of employment that the construction, real estate sectors, the impact that it can have on various other sectors, the employment generation potential is very large if we actually focus on getting these sectors ramped up. Now, the reason why it's not that easy to ramp up an infrastructure or real estate area is because I think historically people have got burnt in terms of investments that they've made. And that has to do with a variety of factors. I don't want to get into the details. Some of them have already been outlined. But I think fundamentally it has to do with risk allocation. And I think the private sector should be asked to take the kind of risks that it is capable of taking. If you ask the private sector to take risks that it should not be taking, then you end up in trouble. And I think fundamentally, if you were to take the infrastructure area as an asset class, globally infrastructure is a low to moderate risk and a low to moderate return asset class. In our country, unfortunately, because of the nature of the opportunity and the exuberance of our entrepreneurial community, etc., unfortunately, it ended up becoming a high-risk, high-return asset class. That is not the right framework in which you develop infrastructure in the country. If you make it a high-return, high-risk, high-return asset class, then this is where you end up. In order to restore confidence, a lot will have to be done for capital to flow back into these areas. And as you rightly said, a large chunk of our developer community that's focused on these areas is stressed in terms of its balance sheet capability, ability to invest in new projects, etc. So that is not a trivial problem to solve for in the near term. Or you will have to get new groups to focus on these areas that have not participated in these areas. And the only way they will participate is if the framework that you outline takes care of the issues that the rest of the community has faced in the past. And you have a structure that actually balances risks in a way that encourages people to come in, and there is visibility of cash flow and visibility of completion, and the government meets its part of the bargain, and then the private sector has to meet its part of the bargain. So that framework has to be evolved. The financing of this is obviously important, because given the volume of capital that is required, I don't think we can fund the country's growth based on bank capital, for a variety of reasons, including the fact that the banks themselves are stressed and don't really have that much growth capital to invest in. Fortunately, over the last couple of years, the bond markets have actually accelerated quite a bit. And a lot of the issuances in the bond markets in the last couple of years has been on account of the banks being constrained. But the reality is that that has been restricted to the higher rated borrowers, and it has been restricted to only a few sectors. So largely it has come from the financial services area and some of the public sector undertakings. That has to do with the fact that institutional capital in our country is actually controlled by 4 different regulators. You have SEBI controlling the mutual funds, RBI, banks, IRDA, insurance, and PFRDA pensions. The largest pools of long-term institutional capital, which is insurance and pension, their risk appetite and the thresholds that the regulators have placed on the insurance and pension companies, pension funds, is actually quite high. So you cannot invest in single A and triple B and all that. These institutions can only invest in double A and higher. You cannot get an infrastructure project rated triple A or double A plus unless you have some serious credit enhancement that is provided. You cannot get there. You will at best get to a triple B level if you're lucky. And then once it is operational and you have steady cash flows, you can then get it re-rated to a double A level, etc., and get the insurance guys to participate. So the reality is that if you're going to be stuck at a double A plus and triple A level, you cannot fund under construction projects. So the framework necessarily has to be the banks, from a short-term perspective, being able to fund under construction projects, because under construction is typically a 3-year period. Once the operations stabilize, cash flow stabilizes, potentially another 2 years. After that, that has to get refinanced in the bond market. But that has to then, be rated appropriately. And I would argue that in a prudent way, the regulators have to also revisit what pool of capital is available for lower rated paper. Because if your largest pools of institutional capital are available only to AA plus and AAA companies, a large part of the landscape is going to be left out in terms of access to capital. And so that also has to be rebalanced in some way. I think international capital is willing to flow in, but there again, you have to be prudent about how much foreign capital you get into debt. And Reserve Bank will also have some concerns surrounding excess foreign debt being relied upon for funding infrastructure, because these are large volumes. So I think it's not that easy to solve. There are several things that need to fall into place in order to get long-term bond markets for funding infrastructure going. I think from a regulatory perspective, the government has done a few things, including the InvIT structure that was put in place recently, whereby developers can actually refinance their operating projects by packaging operating projects into InvIT structures and getting the InvITs listed. There are only a couple of them that have been listed so far. But that's an infrastructure REIT, which basically is a structure that permits recycling of capital. There will be such innovative structures that need to be put in place, and more fundamentally, institutional pools of capital being permitted to invest in the entire spectrum of paper rather than being only AA plus AAA focused.
So now, how would you recommend that projects be structured in terms of finance, plus profile of the finance first by banks, then by the first 5 years, there's no risk of any project being an NPA, right? There's a moratorium, there's a grace period. Only after that, you start paying the service in the debt. If by then the project has progressed a certain extent, it's possible to, as you said, to take out finance, refinance through bonds. How should we go about it?
I think it's a very important, discussion, and it has to be approached from. Use this one. Mahavir, you can use this. Sorry. So it has to be approached from multifarious perspectives, and I'll try to add to a little more different perspective onto this. But before I do that, I must at the outset thank SKOCH Foundation and Mr. Kocher, a true inspiration for youngsters like me, and I'm sure all of us assembled out here. And Mr. Limaye and some of us joined a little late. The kind of story which we heard from Mr. Dhanjal about Mr. Samir Kochar, I think every time I meet Mr. Kochar, I carry an added sense of inspiration. So indeed, thanks for this wonderful opportunity. I think we have to drill down the discussion which we have from both macro and micro perspectives. And at macro level, I agree to the views expressed by the fellow panelists in terms of the infrastructural issues, in terms of the banking issues. Bond market is still in evolutionary stage, and funding has to be a potent combination of debt and equity. And often we see cases of fatal failures because of the over reliance on any of the instruments, be it equity or debt. But the real problem is a lot of projects do not get that potent mix of funds, and India needs to have variety of products, variety of instruments suiting to projects at various levels. And there's a lot of I think ground level work needs to be done in terms of financial awareness, in terms of financial inclusion. And we think of jobs. I think we need to also talk about the smaller projects, the emerging businesses, because if we lay our quick attention on little facts, as per government MSME department, 48 million, close to 5 crore units are MSME, and they are like providing jobs to at least 60 million people every year. So this is a sector which is adding on to the jobs, and since we are discussing on how do we create jobs, I think taking little micro, these are the sector which is by and large kind of needs to be more prioritized. And in 2010, Prime Minister Task Force was constituted to discuss how India can get on to the next level. And one of the fundamental recommendation was that we need to have alternate capital market space for this sector. And then of course exchanges has taken lead, and alternate capital marketplace was set up in 2012. And it's interesting to note that till now we have got more than 300 such units getting listed on stock exchanges. And very interestingly, some of the quick facts to share, more than 50% of these companies which have come and got listed on stock marketplace, they have turnover as less as 50 crores. And more than 30% of the companies listed, close to more than 100 companies that have got listed, the turnover is even less than 20 crores. So there's a new ray of hope which we are witnessing in smaller emerging businesses with turnover of, let's say, 20 crore, 50 crore, 100 crore. And I can say with full conviction, being closely involved in this space, that the businesses have grown phenomenally. They have kind of got onto a very speedy growth trajectory. They have preponed their growth cycle, and with growth funds, besides the banks and private money at initial point of inflection at business life cycle, they have kind of it's very common to come across the companies with, let's say, 20-50 crores of turnover getting on to 100% growth for, let's say, next 3 to 5 years post listing. And that's I must compliment the hand-holding being done by stock exchanges and all the constituents of eco marketplace. So I think we are having 300 companies cumulatively raising 3,000 crores, and if 1% of these companies can be brought to this market, the results and the outcome will be kind of phenomenal. And I personally believe that this is the sector which can even surpass mainboard in terms of market capitalization, in terms of job creation, and it will kind of give India to that next level platform in all respect, including the larger enterprises in making, which will emerge out of this space. So besides those large projects, funding, infrastructural issues, I think more attention, or equal attention needs to be given to this space, and thereby perhaps we can have inclusive growth kind of achieved for laying a foundation for a true new India with kind of prosperity across sectors.
Thank you. before I ask Mr. Bansal, Mr. Limaye has to leave. He has a commitment. So we'll delay him by 5 minutes as it is. Now, would any of the panelists like to raise a query to Mr. Limaye before he leaves? I have one, which is, while it is good that companies have once again started raising money from the market, they are raising money at a price earning ratio of 30%, 50%, 60%. How is this for the long-term sustainability of people coming to the market to invest?
So the issue is really has to do with A, liquidity, and B, the availability of new opportunities to invest in. I think there is a lot of liquidity today. If you look at the flows into domestic mutual funds, they're exceedingly strong. It's a good trend, actually, if you ask me. For a long period of time, we were very heavily dependent only on FII flows, even as far as the equity markets were concerned, whether it was primary or secondary. And even a small withdrawal of FII money, a few $100 million, would move the markets quite sharply, including currencies. Today you have buying power domestically, which is very strong, and that's a healthy trend. Also, when you look at the kind of money that's flown into mutual funds, SIPs is a very healthy trend. So there's almost 6,000 crores a month that flows into mutual funds through SIPs. My hope is that that is a trend that's here to stay, because that just gives you a certain minimum amount of liquidity that is always available to invest. We haven't tested that as yet, because the SIP trend is a trend of only the last couple of years, and the markets have done quite well in the last couple of years. Once the market hits a air pocket and there's some sort of correction, it remains to be seen whether people who've been investing in SIPs actually understand the purpose of SIPs, which is really to invest through cycles and not to try and time the market. But if in a downturn we find that SIPs stop and people start redeeming, then obviously people have not really invested with the right philosophy. So I think liquidity is, if this trend of investing in mutual funds is here to stay, and I think that actually has a long way to go. Because if you look at the percentage of financial savings that are going into markets, it's still a mid-single digit number, which is much lower than what you find in many other markets. And so therefore, better intermediation of retail savings into markets is a trend that we all need to focus on, and that can only grow from where we are. Then the second problem is that if all this liquidity is available domestically, where will it invest in? And that today, the problem is that as capital market issuances are picking up, that will absorb some of the liquidity. And therefore, it's important not only for new companies to list, and certainly in the SME space, the pipeline is strong, but also in the mid-corps and the larger corporates, the capital market issuance pipeline is actually quite strong. But the trend so far, if you look at what the amount of capital that's been raised so far, about 65-70% of that has largely come from financial services companies. So it's not been broad-based across the real economy. It's been concentrated largely in insurance companies, banks, NBFCs, those kind of entities. The second trend is that a large percentage of that money that has been raised is really shareholders selling their shares. It hasn't been primary capital that has been raised for growth. Now that again is a function of where you're in the cycle and whether there are new investments being made by corporates because of which primary money gets raised. But I think it's part of the cycle. So I do believe that there will be primary money that also comes in. I also believe that there will be a broader range of companies across other sectors that will also access markets. But unless we get more companies to list and more capital raising done in primary form, you will face this issue of more and more money going into the same securities, and that by definition is a demand-supply mismatch resulting in stock prices going up. And if you look at the multiples at which the overall market is trading, it's certainly higher than what the historical multiples have been, and that should be a cause of concern, because fundamentals will need to catch up. It cannot be purely liquidity driven and technical driven. Fundamentals have to keep pace with prices. And my hope is that fundamentals will catch up. So if growth does pick up over the next 2-3 quarters, since demonetization, GST, etc., are behind us and will stabilize, then with earnings catching up and GDP growth catching up, you will be able to grow into the valuations that you're seeing today. But if that doesn't happen, then high multiples based purely on liquidity is a cause for concern.
Anything you'd like to ask? Yeah.
As Mr. Limaye mentioned about the pricing, my question is same on that issue. Now whatever new companies are coming, if you see the pricing which is mainly done by the merchant banker, that is on too high side, and even in the existing companies also, price earning ratio, if you see worldwide also, it is much higher. So means again too much liquidity is changing the same market. It's a good, but overall if you see, it generally happens in India whenever market is booming, stock prices go very high, but the moment it is the other way around, it will come down drastically. So for investor, there is a matter of concern. So
I don't disagree. I think if you look at even the commentary globally or even in the developed markets, even in the United States, a lot of the people have in fact been talking about the fact that all asset prices seem to be at elevated levels, not justified by fundamentals. Again, has to do with liquidity in terms of what the Federal Reserve and other central banks around the world have done. But again over there, the hope is that because growth in the United States is picking up, and if based on government policy, whether it's tax policy or otherwise, if it's going to result in growth catching up to valuations, then as we know, equity markets are always forward looking. So they will price in what they expect to see. If you disappoint on expectations, you will see a severe correction, because this is building in pretty high expectations.
While discussing with you, Vikram, you had mentioned that few of the exchanges, which is the commodity exchange, they may also be allowed to do the equity trading and all in times to come. You are a market leader. Almost you have got around 85-90% of the market share in all the aspects. And few of the stock exchanges in the past are the defunct, whether it's the Delhi Stock Exchange or Ludhiana Stock Exchange or Kanpur. Do you really think that there is any need for this commodity exchange to participate into the equity and other part also? Because that question is particularly for the thinking of Mr. Samir Kochar to take it forward, whether really we need it and what will be the add-on in case at all these are being allowed.
See, actually, there are different models. If you look at the United States, there are, 40, 50 different trading platforms. It's not one exchange. If you look at certain other parts of the world or many parts of the world, you will actually find just one exchange. You don't even have two. Fundamentally, if you divide up liquidity, it doesn't really get you the best impact in terms of efficiency of markets and price discovery, etc. To the extent that you have more concentrated liquidity and trading, it gets you better price discovery and more efficiency. Now, in India, you have 4 exchanges today, and the reality is that even if you permit all exchanges into all asset classes, it's not the case that liquidity currently is divided up. As you said, even as it relates to equities and certain other markets, there is liquidity that is concentrated. It's not that it's divided up. Likewise, in commodities, MCX has the dominant share in the non-agri, and NCDEX has the dominant share in the agri commodities market. So, liquidity does get concentrated in ways, and so I think from a policy perspective, if the view is that, and rightfully so, that exchanges should be permitted to be in all asset classes, then there's nothing wrong in MCX and others getting into other areas. It's not clear that that will necessarily result in bifurcation of liquidity, but from a policy perspective, it will encourage more competition, and that's not really bad from a policy perspective or from an economy perspective.
Thank you.
So a lot has been talked about, quickly, about
can take this.
startups, but that market as a subset or a dedicated platform has kind of could not see the light of the day. So one of the thought is that maybe startup or SME platforms can be kind of merged, where the new age businesses can be kind of permitted with whatever relaxations they kind of need. So what's your perspective, and how India can have a kind of active platform for startups going forward?
So as you said, today we have certainly a platform for SMEs that's called NSE Emerge, and you've actually been a very active participant in that market in terms of bringing new companies to market. That has been a very successful platform. I think that's a very important initiative, and NSE is certainly doing its bit in terms of doing whatever it takes to provide access to capital to SMEs, because that's a very important part of the landscape from a job perspective as well as growth perspective. And while the NSE Emerge platform provides access to equity capital, we also have a platform along with SIDBI for debt capital for SMEs, and it's called RXIL, which is the TREADS platform, and that effectively provides discounting of receivables for SMEs so that they get money up front from a working capital perspective, and the financier of that is really taking the risk of the buyer, which is a much stronger corporate. So that platform again has a lot of room for growth, and recently from a policy perspective the government has made it mandatory for all the PSUs to list on the TREADS platform, so that their entire supply chain can get access to faster financing and cheaper financing, because the risk that the financier is taking is of the buyer, not of the MSME or SME. Coming back to your point on startup companies, we just recently did a conclave in Bangalore for startup companies to discuss to actually educate them on the merits of listing in India as opposed to thinking about offshore listing, and the fact that the ecosystem in India is now relatively well developed to think about a domestic listing, and you can think about a dual listing, but certainly think about a domestic listing, because over the last 6, 7, 10 years, a lot of money from the VC community and the private equity community has flown into emerging technology companies, whether it's pure technology, biotechnology, etc. And as I said, the flows into mutual funds and domestic buying power for IPOs and in the secondary market is now exceedingly strong. So it's no longer the case that if you go to NASDAQ or the US or London or something is where you will get better price discovery. The domestic ecosystem is strong enough to support these companies. There is a separate platform for startups that SEBI actually authorized, which has much lighter regulation taking into account the nature of startup companies, and the regulation surrounding that and when you can list is very different from what you can do on the main board or even the SME. And I think people should take advantage of that platform. If there are some tweaks required there, I think we are more than happy to represent that. We have already got some feedback. We will take it up with SEBI. I think SEBI will also be very supportive of encouraging that landscape. So my hope is that over the next 12 to 24 months, you will see many more startup and emerging technology companies list in India.
So while financing is a very large part of building infrastructure and creating growth, that by itself cannot really produce growth. Mr. Bajaj talked about certain issues. If you finance a project based on a particular price profile for the output, and suddenly that output price is no longer valid because the government which was supposed to buy that output at a particular price suddenly decides, no, I must ask for a lower price, then the project goes kaput. Now, in the power sector, 30% of the power that is produced in this country is not paid for. Can any industry survive if 30% of output is lost? Now, we have a very civilized term for this. This is called the technical and commercial losses. This sounds fairly civilized. It's actually theft. Technical losses cannot exceed 11%. The rest of the power that is missing is actually theft. Unless we have the political will to stamp out theft, how can you ever have a functional power sector? Would you like to say something on this?
So I entirely agree on this point, and there has been a lot of discussion, because electricity feeds into all industries. It's a basic necessity if you want to have manufacturing, if you want to have services. The result of having very high losses is that in India today, the cost of electricity is the highest among the world. And what it does is it makes our products and services much less competitive as compared to global service providers. We compete in many of these products, number one. Point number two, what you said, uncertainty about PPAs. The uncertainty in PPAs today is a result of the fact that at one end we have a situation where power appears to be seemingly surplus. But on the other hand, we have a huge mass of population in rural areas, point one, and an equally large mass of population in urban areas who don't get supplies. So in rural area, you may not even have distribution network, and in urban areas, you have distribution networks which are terrible, not maintained, and unable to deliver electricity. So you have a bottleneck in the system which needs to be corrected. And that I entirely agree. We need a drastic surgery there. It's not cosmetic playing around which you need to do. And if you do that, a lot of these projects are fundamentally viable. We shouldn't be having NPAs on these projects.
Exactly. Increasingly, politics is to blame for many things we have. In Delhi, we don't have 24/7 water supply. There are 28 cities around the world where the per capita availability of water is far below Delhi, but still manage to supply water round the clock. Why? Because around 45 to 50% of the water in Delhi that is piped is lost due to wastage. There is leakage. If you want to have a pipeline system that is leak-proof, you need to invest in it. And if you invest in it, the cost goes up. That cost must be realized from the consumers. In Delhi, we are ready to buy water from Bisleri in huge cans. We are willing to invest in Kent and other branded RO purifiers. We are willing to buy water tankers, but we are unwilling to pay the utility 1 rupee extra if they say this is what it will take to get extra water. Who is to blame for this? Are we the public to blame, or is the politician who has conditioned people to believe that if a facility is given by the government, it ought to be free? Now, these are issues which are outside any technocrat's realm. These are issues in the realm of politics. And unless the politician changes his attitude to infrastructure, it cannot be financed. Now, Mr. Lunawat raised a very important issue of our small and medium enterprises. GST is actually making the informal sector history. If you have to file your returns within 2 months in order to get a claimed input tax credit, you file your return. This will make all your accounts transparent. There will cease to be an informal sector if you're part of the GST network. What this also means is that the small and medium enterprises which today rely on the informal sector for finance, up to 85% of the requirement, will need to make that finance also transparent. Are those financiers prepared to make it transparent? If the local MLA has been routing his illicit riches through a set of chartered accountants to the small and medium enterprises in the region, will he want this money to be revealed? If not, how will these companies function? Are banks prepared to extend their reach of formal finance to allow these companies to tap their funding? Mr. Bajaj.
In fact, most of the banks, for particularly current financial year, priority is to finance MSME sector. Under the Mudra loans up to 10 lakhs, there are 3 categories, and those loans are covered under the guarantee scheme CGD, MSC. And our experience is that NPA in those account is also very less, means repayments are also coming. Only thing is we have to tell the borrower, because otherwise, as rightly said, earlier they used to take from the informal sector at any rate 20%, 25%. In fact, in many meetings, when we checked like microfinance banks and others, they are also charging almost 20%. When we told them, why you are taking this money from them at such a high rate when we can give you at much lower rate, plus many state governments are paying them the subsidy also, and actual rate of interest comes only to 4%. Actually, it is a lack of understanding and knowledge, and in fact, we have to educate them. This is one of the things. And other loans like startups, up to now it is 2 crores and other thing. Banks are encouraging, and in fact, only problem is because earlier they were doing through informal ways, they don't have the correct data to analyze. But right now, they are also, after this GST pattern, many of them, they are moving, they are also understanding. Once they will go through the formal way, and they will able to tell the turnovers and other things, I think we are basically giving them lot of strength from the banking system. And in fact, there is a much growth of almost 15 to 18% in this sector itself in this current financial year, if overall growth is hardly anything in the particularly corporate sector.
So, Mr. Arun, you raised very important question. I'm tempted to make a couple of submissions without taking too much of time. There was a lot of hue and cry when the GST was kind of implemented, particularly in the smaller segment, unorganized sector. The companies will perhaps not survive. This whole SME platform will not kind of it will have a lot of challenges. But I'm very happy to share. I'm sure all of you will be happy to note that after demonetization, after GST, there has been marked incremental growth in terms of number of companies and fundraise that is happening at the MSME platform. And after GST, if we look at the statistics, more than 30 to 35% increase in the number and in terms of value of the funds that are being raised. So that I think gives a lot of confidence to this sector that these kind of reforms, which were kind of there were a lot of apprehensions around that, but I think that's strengthening the sector, and I'm sure platform like SKOCH will give that right kind of signals to this sector. And very quickly coming on to the, since Mr. Bajaj touched upon investing or startup investing should also be covered under the priority investing framework. So there should be a framework of priority investing which should be introduced, like how we have debt covered in priority sector. The investing in MSME should also be, the equity investing should also be covered under the priority sector, which will give a lot of boost of this entire concept, and perhaps it will transform the sector very fast.
Samir, probably you should have one session just on the RBI's regulation of fintech companies. Fintech had the potential to actually revolutionize mediating savings to the small and medium sector. But my feeling is that the caps that the RBI has put on how much money a person can lend and how much money a person can receive on this fintech platform is so low, it has virtually ceased to be a major player in the sector. Perhaps we need to rethink this and raise some concern about this.
We have a session tomorrow. Fintech, all the companies, including RBI,
Yeah.
we can just take a note of it.
Any thought on this?
Not exactly on this. I got one or two observations in case kindly you provide this opportunity to me. What we are saying that, okay, banks are going through a very bad phase right now. over, you can say that 10 trillion INR is bad assets in that case, and we are talking about now FRDI to be introduced. So my submission to you as well as to Samir would be that a note is to be taken forward, because that there is a fear psychosis into the investor, into the banking community, particularly in case you have got more than a lakh of rupees which is not insured, or few of the banks which their savings bank is covered by the insurance and all. So that sort of thinking is to be kept out of the mind of the investor. Otherwise, it's going to be very, very alarming. Number two, that NCLT thing which is happening on the stress assets and appointing IRPs and all, is not going to help anybody. You have seen in the past that in the steel industry or the power, the things which are happening needs to be re-looked at, because when we are talking about that generation of employment and infrastructure to be developed, so these are the factors to be taken into consideration. That's what my limited point.
Yeah. I mean, there is so much to speak about this subject. I'm sure we can't go on till evening, but we must wind up now, and I request Kusharan to close.
If there is anything from the house that may be added to it,
Sure.
Any question there somebody wants to ask? You have a question? Yeah. Can I get a mic?
Sir, there is a huge knowledge and subject. It is a huge subject of economics. My simple question is that what can a common man do to improve the economy of India? Just like I am a common man, as a salary person or a small business. What can I do to improve, play a role in to improve economy of India?
Anybody who would like to answer this?
I think all of us are common man in that perspective. We just kind of keep on doing in terms of how our objectives are aligned to national objectives, and small things can be or should be introspected on a regular basis, that our steps or our actions should not be contrary to, let's say, the overall objectives, broadly speaking.
So essentially speaking, I think what he is referring to, being a common man, as somebody who would like to access some kind of a capital, some kind of a hand holding by the established institutions. Perhaps from that perspective, the panel could make a few recommendations, you being there as a merchant banker, you being there as a banker, and obviously when you get connected with the market. So what is it that possibly can be helped, particularly even from the employment generation perspective?
So there are various facets. I mean, I'm taking, you have made it simple for us. So one is, the entrepreneurial perspective, that let's say if we aspire to kind of start up business, so how do we go about that? And I think you would have got a glimpse of, there are various options available in terms of startup funding by banks, in terms of priority lending, in terms of the whole lot of alternate capital marketplace which is supporting the new businesses by whatever name we call it, whether MSME or startup. And the other side of a common man is to where money should be invested. And I often say that in today's context, and there have been some questions and discussions on the valuations and returns on stocks in today's scenario. So a little bit of behavioral diligence would be of added help in addition to what we see in prospectus or offer documents or read through in risk factors. So particularly in the startup or emerging businesses. So we should be very wary of where we are putting money, and there is a lot of science and a lot of knowledge available through exchange platforms and through other regulatory platforms, and a whole lot of diligence is being done by merchant bankers like us. So I think we are in a very matured stage where investor protection is at the foremost. So these are the two things from these two perspectives I thought I'll just respond. So
yeah. I'll just add a couple of things. We are a very low trust society. High trust societies are more efficient because a whole lot of contractual legal obligations that you enter into just to ensure that outcomes happen the way they're supposed to are avoided in those high trust societies, whereas we cannot do that. We don't follow rules. As a common citizen, we can follow rules. I was knocked down day before yesterday by a bike that came from the wrong side. For no fault of mine. So if you follow rules, these kind of accidents will not happen. If a politician promises you will get power for free, tell him he is a fraud. Many things cannot happen because everything has a cost. And populist policies should be rejected by citizens on the ground that these are unsustainable and will do the society long-term harm. These are things that a common man couldn't do apart from his interest in finance. I think we must.
If I can add a quick point, I see a lot of young people here, and I think it's important that you all have an ambition, have a dream. As Samir said, sapna dekhna hai. We can do a lot. India has a huge demographic dividend, and I see a lot of opportunities globally. If you look at the technology and how digitization is happening, we are at the center of it, and we should take advantage of it. I see the role of government here, to enable this to happen, enable these dreams to bloom. It's a huge, tremendous opportunity.
I think that's a